The assembly lines have stopped, the factories have gone dark, the workers have been sent home. At this very moment, across 3 continents, some of the largest electric vehicle manufacturing facilities on the planet are sitting idle. Not because of a labor strike, not because of a power outage, not because of a pandemic. Because of silver. Because the price of silver has reached $118 per ounce, and the automakers cannot afford to buy the metal they need to build their cars. This morning, Tesla announced an emergency production halt at its Gigafactory in Austin. This afternoon, Volkswagen suspended EV production at 3 European facilities. Tonight, BYD, the Chinese EV giant that was supposed to dominate the global market, confirmed that it has paused output at 2 of its largest plants. The electric vehicle revolution, the centerpiece of the green energy transition, the multi-trillion-dollar bet that governments and corporations have made on the future of transportation, has crashed into a wall, and that wall is made of silver. Ladies and gentlemen, this is Silver Storm Daily, and what is happening right now is the most significant industrial crisis of the 21st century. The EV industry is breaking in real time. The silver shortage that we have been warning about for years has finally manifested in a way that cannot be ignored, cannot be papered over, and cannot be solved by printing more money. $118 silver has broken the economics of electric vehicles, and the consequences are going to reshape the global economy in ways that most people cannot yet imagine. Let me walk you through exactly what happened because the mainstream media is not giving you the full picture. They are reporting the production halts as isolated incidents. They are blaming supply chain issues and temporary disruptions. They are doing everything they can to avoid saying the word that explains everything. Silver. The word they are terrified to say. Because if they said silver, they would have to explain why silver is at $118. And if they explained that, they would have to admit that the entire financial system is breaking down. They would have to acknowledge the manipulation, the shortage, the monetary crisis. They would have to tell you the truth. And the truth is not something that the mainstream media is in the business of telling. Here is what actually happened. Every electric vehicle requires between 25 and 50 grams of silver. This silver is used in the electrical contacts, the battery management systems, the charging infrastructure, the motors, the sensors, and dozens of other components. There is no substitute for silver in these applications. Copper does not have the same conductivity. Aluminum does not have the same durability. Gold is even more expensive. Silver is the only metal that provides the performance characteristics that EVs require at a price point that made economic sense, but that price point was based on silver trading between $20 and $30 per ounce. At those prices, the silver content in an EV costs between $15 and $50 per vehicle, a rounding error in the context of a $60,000 car. At $118 per ounce, the math has changed catastrophically. The silver content now costs between $95 and $190 per vehicle. For a company like Tesla, which produces 2 million vehicles per year, that is an additional $200 to $300 million in annual silver costs. For the global EV industry, which is targeting 50 million vehicles per year by 2030, the additional silver cost approaches $10 billion annually. $10 billion that was not in the budget, $10 billion that cannot be passed to consumers without destroying demand, $10 billion that does not exist. But the cost increase is only part of the problem. The bigger problem is availability. At $118 per ounce, the automakers were willing to pay. They had no choice. They need the silver to build the cars. But when they went to the market to buy, they discovered something terrifying. There was no silver available at any price. The refineries were sold out. The wholesalers were sold out. The industrial suppliers were sold out. The silver that was supposed to flow through the supply chain to the factories had vanished. It had been absorbed by investors fleeing the collapsing fiat currency system. It had been accumulated by Eastern central banks building strategic reserves. It had been consumed by the solar industry, the electronics industry, the medical device industry. Everyone needed silver. Nobody had silver. And the automakers were left holding purchase orders that could not be filled. The production halts began yesterday. Tesla was the first to announce. Their statement was carefully worded to avoid mentioning silver by name. They cited supply chain disruptions affecting critical materials, but sources inside the company confirmed that the critical material was silver. The Austin Gigafactory requires approximately 800,000 ounces of silver per year to operate at full capacity. Their inventory had run dry. Their suppliers could not deliver. They had no choice but to halt production. Volkswagen followed within hours. Their announcement was even more vague. referring to temporary adjustments to production schedules due to commodity market conditions. But the pattern was clear. 3 EV-focused facilities in Germany and Slovakia went dark simultaneously. Volkswagen's annual silver consumption for EV production exceeds 2 million ounces. They could not source the metal. BYD's announcement came late tonight, Chinese time. The company that has been hailed as the Tesla killer, the company that sold more EVs than any other manufacturer in 2024, confirmed that 2 major production facilities had paused operations. Their statement blamed exceptional market conditions in key input materials. The exceptional market condition is silver at $118 with no available supply. Let me put this in context. The global EV industry was supposed to be the future. Governments have mandated the phase-out of internal combustion engines. Corporations have committed hundreds of billions to electrification. Investors have valued EV companies at trillions of dollars based on projections of exponential growth. The entire narrative of the 21st century economy has been built around the assumption that EVs would dominate transportation. That assumption was always dependent on cheap silver. Nobody said it out loud. Nobody included it in the investor presentations. Nobody stress-tested the business models against a scenario where silver reached $100 or more. They assumed that silver would always be available at $20 to $30 because that is where it had traded for most of the past decade. They did not understand that the price was artificially suppressed. They did not understand that the shortage was building beneath the surface. They did not understand that the manipulation could not last forever. Now they understand. Now they are staring at dark factories and laid-off workers and production targets that cannot be met. Now they are scrambling to find silver that does not exist at prices they cannot afford. Now the house of cards is collapsing. Let me explain why silver at $118 breaks the EV economics in a way that cannot be easily fixed. The EV industry operates on thin margins. Unlike luxury goods where there is room to absorb cost increases, EVs are competing with internal combustion vehicles that have had a century to optimize their cost structures. Every dollar of additional cost in an EV is a dollar that makes the EV less competitive with a gasoline car. The entire EV value proposition depends on achieving cost parity with traditional vehicles. Silver at $118 destroys that parity. Consider a mid-range EV that sells for $45,000. The manufacturer's margin on that vehicle is approximately $3,000. That is the profit after paying for materials, labor, assembly, marketing, and distribution. A $3,000 margin on a $45,000 car is 6.7%. This is already thin by automotive standards. Now add the silver cost increase. At $30 per ounce, the silver content cost $40 per vehicle. At $118 per ounce, the silver content costs $157, an increase of $117. That does not sound like much relative to a $45,000 car, but relative to a $3,000 margin, it is a 4% reduction in profitability. And that is just silver. The same dynamics are playing out in copper, in lithium, and rare earths. The entire input cost structure is inflating while EV prices are under pressure from competition. The automakers face an impossible choice. Choice 1 is to absorb the cost increase. Accept the margin compression. Continue producing at lower profitability. This might work in the short term, but it is not sustainable. Investors expect margins to expand as production scales, not contract. If margins are falling, the stock price falls. If the stock price falls, the ability to raise capital falls. If the ability to raise capital falls, the ability to invest in future production falls. The death spiral begins. Choice 2 is to pass the cost increase to consumers. Raise EV prices by enough to maintain margins. But EV demand is already price sensitive. The mass market adoption that everyone is counting on depends on EVs being affordable. If you raise prices by $500 or $1,000 to cover commodity inflation, you lose customers. The customers who were on the fence about buying an EV decide to stick with their gasoline car. Sales fall. Production falls. Scale economies are lost. Costs go up further. Another death spiral. Choice 3 is to halt production until the market stabilizes. This is what Tesla, Volkswagen, and BYD have chosen. Stop the bleeding. Wait for silver prices to fall. Hope that the supply chain normalizes. But this choice has its own devastating consequences. Idle factories still have fixed costs. Workers who are sent home may not come back. Customers who cannot buy their EV buy a competitor's car or delay their purchase entirely. Market share is lost. Momentum is lost. The narrative of inevitable EV dominance is shattered. There is no good choice. Every path leads to pain. This is what happens when an industry builds its future on an input that it did not control and did not understand. The EV industry bet everything on silver being cheap and available forever. they lost that bet. Now let me explain why this is not a temporary disruption and why silver at $118 may be the new normal or even the floor for much higher prices. The forces that have driven silver to this level are structural and accelerating. The first force is the supply deficit. Global silver mining production is approximately 850 million ounces per year. Global silver demand, combining industrial, investment, and monetary uses, now exceeds 1.1 billion ounces per year. The deficit is 250 million ounces annually. This deficit has persisted for 4 consecutive years. Each year, the gap is filled by drawing down above-ground stockpiles. But the stockpiles are finite. The COMEX registered inventory is at historic lows. The LBMA inventories are shrinking. The ETF holdings are being drained. The above-ground silver that is supposed to buffer the market against supply disruptions is disappearing. When it is gone, the price will have to rise high enough to either stimulate new supply or ration demand. That price is not $118. That price is $200, $300, maybe higher. The second force is the demand explosion from sectors beyond EVs. The solar industry is the largest industrial consumer of silver, using over 150 million ounces annually. Solar installations are growing at 20 to 25% per year. Each percentage point of growth requires additional silver. 5G telecommunications infrastructure requires silver. Artificial intelligence data centers require silver for the massive electrical connections. Medical devices require silver for its antimicrobial properties. Military applications require silver for electronics and sensors. Every major technology trend of the 21st century is silver-intensive. The demand is not just growing, it is compounding. The third force is the investment demand that has emerged as the fiat currency system fails. For decades, silver was an industrial metal that attracted modest investment interest. That has changed. The explosion of government debt, the monetization of deficits by central banks, the persistent inflation that has eroded purchasing power, all of this has driven investors into hard assets. Gold has led the way, but silver is following. The investment demand that used to be 20 or 30 million ounces per year has surged to 150 million ounces. Retail stackers are accumulating coins and bars, institutional investors are buying allocated metal, sovereign wealth funds are diversifying into precious metals. This investment demand is competing with industrial demand for a shrinking pool of available silver. The fourth force is the failure of new mining supply to respond. Silver mining is predominantly a byproduct of gold, copper, lead, and zinc mining. Only a quarter of silver production comes from primary silver mines. This means that silver supply does not respond directly to silver prices. A copper mine produces silver regardless of whether silver is at $30 or $118. The copper economics drive the decision. The silver is incidental. The primary silver mines that could respond to higher prices are small and take years to develop. The exploration spending during the decade of low prices was minimal. The pipeline of new projects is thin. Even if silver stays above $100 for years, the supply response will be slow and limited. These four forces, the structural deficit, the demand explosion, the investment surge, and the supply constraints, are not going away. They are intensifying. Silver at $118 is not an aberration. It is the market beginning to price the reality that has been obvious to anyone paying attention. The shortage is real. The competition for available metal is fierce. The price must rise until demand is rationed or supply expands. Neither will happen quickly. Now let me explain what the EV production halts mean for the broader economy, because the consequences extend far beyond the automotive sector. The electric vehicle industry is not an isolated sector. It is the tip of a massive supply chain iceberg that touches every corner of the global economy. The EV battery supply chain employs millions of workers directly. Lithium miners in Australia and Chile, cathode and anode manufacturers in China and Japan, battery cell producers in Korea and Germany, battery pack assemblers in the United States and Hungary. When EV production halts, the orders stop flowing through this chain. Workers are laid off, factories are idled, investments are delayed. The economic ripple effects spread. The EV component supply chain is equally vast. Semiconductor manufacturers who have invested billions in automotive chips see their orders canceled. Electric motor producers who expanded capacity to meet EV demand face empty order books. Charging infrastructure companies that were expecting explosive growth find their customers distracted and unable to invest. The entire ecosystem that was built around the assumption of EV growth is suddenly in question. The financial markets are beginning to price the disruption. Tesla shares fell 12% today on the production halt announcement. Rivian fell 18%. Lucid fell 22%. The EV-focused ETFs are down across the board. The capital that was rushing into electrification is now rushing out. The billions in planned investments are being reconsidered. The growth projections that justified trillion-dollar valuations are being revised downward. The government policy implications are equally severe. The United States, the European Union, China, and other major economies have committed to EV mandates. They have set dates for banning the sale of new internal combustion vehicles. These mandates were based on the assumption that EV production would scale rapidly to meet the demand. But if production is constrained by silver availability, the mandates become impossible to meet. Governments will face a choice between enforcing unachievable mandates and destroying their automotive industries, or abandoning the mandates and admitting that the green transition was based on faulty assumptions. Either choice is politically devastating. The geopolitical implications add another layer of complexity. China produces 70% of the world's refined silver. China controls the processing of the rare earths, lithium, and other materials that EVs require. China has been building a dominant position in EV manufacturing and battery production. The silver shortage gives China leverage that it has not previously had. If China chooses to restrict silver exports, as it has restricted rare earth exports in the past, the Western EV industry would be completely paralyzed. The energy transition that was supposed to reduce dependence on foreign oil could instead create dependence on Chinese silver. The strategic vulnerability is enormous. Let me now connect this EV crisis back to the silver market and explain what it means for the price going forward. Because the EV production halts are not just a story about the automotive industry. They are a story about what happens when the physical world collides with the paper world. They are proof that the silver shortage is real and that the consequences are arriving. For years, the silver bulls have argued that the physical shortage would eventually manifest in ways that could not be ignored. The skeptics dismissed these arguments. They pointed to the stable price around $20 to $30. They said that if there was really a shortage, the price would reflect it. They did not understand that the price was manipulated. They did not understand that the paper market could create the illusion of supply where none existed. They did not understand that the reckoning was coming. The EV production halts are the reckoning. This is the shortage becoming visible. This is the moment when the paper price and the physical reality can no longer be reconciled. This is what we have been waiting for. The market response to the EV crisis will accelerate the silver rally. The headlines about Tesla halting production, about Volkswagen idling factories, about BYD pausing output, these headlines will reach audiences that silver stackers have never been able to reach. People who never thought about silver will now be thinking about silver. Investors who dismissed precious metals as fringe will now be reconsidering. The narrative is shifting in real time. The industrial users who have taken silver for granted are now panicking. They are rushing to secure supply at any price. They are signing long-term contracts. They are building inventory buffers. They are willing to pay $130, $140, $150 per ounce if it means guaranteeing supply. This panic buying is adding to the demand pressure that created the shortage in the first place. The feedback loop is accelerating. The paper shorts who have been suppressing the price are facing an impossible situation. The physical market is screaming that silver is worth more than $118. Every EV factory that halts production is proof that the paper price is wrong. Every delivery failure on the COMEX is proof that the paper market is disconnected from reality. The shorts can sell more paper, but they cannot create physical silver. The manipulation is failing in the most visible way possible. The forward curve in the silver futures market has inverted. This is called backwardation. It means that silver for immediate delivery is trading at a premium to silver for future delivery. This is the opposite of the normal structure where futures trade above spot. Backwardation is the market's way of screaming that there is a shortage right now. It is a sign that the physical market has taken control from the paper market. Based on all of these factors, I believe that silver at $118 is not the top. It is a waypoint. The structural forces driving the price higher have not been resolved by the rally so far. The deficit is still present. The demand is still growing. The supply is still constrained. The investment demand is still surging. The EV crisis will intensify these forces rather than relieving them. My near-term target is $140. This is the level where the EV industry will be forced to make fundamental changes to their product designs. At $140, the cost of silver in an EV becomes prohibitive. The automakers will begin emergency programs to reduce silver content. They will accept lower performance. They will redesign circuits. They will invest in alternatives that they previously dismissed as inadequate. This process will take years. During those years, silver demand from EVs may actually decline, but the demand from other sectors will continue growing, more than offsetting any reduction from automotive. My medium-term target is $200. This is the level where silver's monetary role begins to dominate its industrial role. At $200, silver is clearly being valued as money, not just as a commodity. The investment demand will surge further. The central bank accumulation will accelerate. The flight from fiat currencies will intensify. The very factors that are driving the rally will compound. My long-term target is the inflation-adjusted high from 1980, which is approximately $350 in today's money. Silver reached $50 in 1980. Adjusted for the official inflation since then, that is $190. Adjusted for real inflation, which is higher than the official numbers, that is $350 or more. We have not yet reached the inflation-adjusted high. The bull market has room to run. Now let me address what this means for you specifically and what you should do in response to the EV crisis and the silver rally. Because understanding the analysis is only useful if you know how to act on it. First, recognize that the EV production halts are validation of everything we have been saying. For years, this channel has argued that the silver shortage would have real-world consequences. For years, we have warned that the industrial demand was growing faster than the supply. For years, we have predicted that the manipulation would fail and the physical market would take control. The EV crisis is proof that we were right. The consequences are arriving exactly as we predicted. Second, understand that the EV crisis is just the beginning. The solar industry uses more silver than the EV industry. The electronics industry uses as much. The medical device industry is growing rapidly. Each of these sectors will face the same crisis that the EV industry is facing now. As they compete for limited silver supply, the price will continue rising. The production halts at Tesla and Volkswagen are the first dominoes. More will follow. Third, if you own physical silver, hold it. The temptation to sell at $118 is understandable. You have already made massive gains. The psychological satisfaction of locking in profits is real, but the fundamentals say that prices are going higher. The EV crisis confirms the shortage. The production halts prove that the industrial demand is real. Selling now means selling before the story is fully priced in. Hold your mettle. The best gains are still ahead. Fourth, if you have cash available, consider buying more. Yes, $118 is expensive compared to where silver was 2 years ago, but it is cheap compared to where silver is going. The EV crisis is the kind of catalyst that shifts the entire market narrative. Investors who were not paying attention are now paying attention. Demand is about to surge from a new cohort of buyers. The supply is not going to increase meaningfully for years. Buying now positions you ahead of the crowd. Fifth, consider the silver miners as a leveraged way to participate. The mining companies that produce silver have operating leverage. Their costs are relatively fixed. When silver rises from 100 to 150, their costs do not rise proportionally. Their margins expand dramatically. A company that earns $10 per ounce profit at $100 silver earns $60 per ounce at $150 silver. The stock prices can multiply rapidly. The miners have underperformed the metal for months due to manipulation. That underperformance is creating an opportunity. Sixth, stay informed and stay connected. The situation is evolving rapidly. The EV production halts announced today may be followed by additional announcements tomorrow. The government responses are unpredictable. The market reactions are volatile. You need real-time information from sources that understand the silver market. This channel is committed to providing that information. Subscribe if you have not already. Turn on notifications. Share with others who need to understand what is happening. Let me now address the broader implications of the EV crisis for the future of transportation and energy. Because the halts announced today are not just a temporary disruption, they may mark the end of the electric vehicle narrative as we have known it. The EV revolution was always based on assumptions that were not adequately examined. The assumption that critical minerals would be available in sufficient quantities. The assumption that battery costs would continue declining. The assumption that charging infrastructure would scale rapidly. The assumption that consumer preferences would shift smoothly from gasoline to electric. Each of these assumptions is now being tested. The silver shortage is just one element of a broader minerals crisis. Lithium prices have also surged, tripling over the past 2 years. Cobalt prices are up 50%. Rare earth prices are volatile and subject to Chinese export restrictions. The entire bill of materials for an EV is inflating at rates that the industry cannot absorb. The silver shortage is the most visible symptom of a systemic problem. The battery cost declines that enabled EV adoption have stalled. For a decade, battery costs fell steadily, from over $1,000 per kilowatt hour to under $150. This decline was driven by scale, by manufacturing innovation, and by cheap input materials. But input materials are no longer cheap. Scale economies have been captured. The learning curve is flattening. Battery costs are now rising for the first time in the industry's history. The charging infrastructure build-out is behind schedule. Governments and utilities have promised millions of charging stations, but the actual deployment is lagging targets by years. Consumers cite charging anxiety as a primary reason for hesitating to buy EVs. The production halts will slow the rollout of new vehicles, which will reduce the urgency to build charging infrastructure, which will reduce consumer willingness to buy EVs. Another negative feedback loop. Consumer preferences are proving more durable than the EV advocates expected. Many consumers prefer the convenience, range, and familiarity of gasoline vehicles. They are not motivated by environmental considerations or government mandates. They buy EVs when the economics make sense. If EV prices rise while gasoline prices moderate, the economics shift back toward traditional vehicles. The assumption that EV adoption would proceed in a straight line upward was always naive. The EV production halts may mark an inflection point where the narrative shifts from inevitable dominance to uncertain future. The companies that have bet everything on electrification will face existential questions. The investors who have valued these companies at enormous multiples of revenue will reassess. The governments that have mandated the end of internal combustion will face political backlash. The entire green transition that was supposed to solve climate change is suddenly in question. This is not an argument against EVs or against addressing climate change. It is a recognition that the path forward is more complex and more constrained than the advocates acknowledged. The constraints are physical, they are geological, they are geopolitical. Silver is one constraint among many, but silver is the constraint that is biting right now, today, in the form of dark factories and idle assembly lines. Now let me talk about who is responsible for this crisis, because accountability matters. The EV industry is suffering, but the suffering was not inevitable. It was the result of decisions made by people who should have known better. The automakers are responsible for building their strategies on assumptions about commodity prices without stress testing those assumptions. They assumed silver would stay at $20 to $30 forever. They did not hedge their silver exposure. They did not secure long-term supply contracts at fixed prices. They did not invest in alternatives or in reducing silver content. They were complacent. They are now paying the price. The investment banks are responsible for promoting the EV narrative without disclosing the commodity risks. They underwrote billions in equity and debt offerings for EV companies. They published research reports with aggressive growth projections. They earned fees at every step. But they did not highlight the dependency on silver and other critical minerals. They did not warn investors that the entire thesis could be undermined by commodity shortages. They were negligent or dishonest or both. The governments are responsible for mandating EV adoption without ensuring the supply chains to support it. They set dates for banning internal combustion vehicles without securing the minerals needed to build the replacements. They offered subsidies and tax credits that stimulated demand without stimulating supply. They created the conditions for a crisis, and now they are surprised that the crisis has arrived. The bullion banks are responsible for suppressing the silver price and creating the illusion of abundance. For decades, they sold paper silver that was not backed by physical metal. They kept the price artificially low. They signaled to the market that silver was plentiful when it was not. The automakers who assumed silver would stay cheap were responding to price signals that the banks had manipulated. The shortage was hidden by the manipulation until it could no longer be hidden. Each of these parties bears some responsibility. None of them will admit it. They will blame each other. They will blame unforeseen circumstances. They will blame forces beyond their control. But the crisis was foreseeable. We foresaw it. We warned about it. The information was available to anyone willing to look. They chose not to look. They are now paying the price. Let me close with perspective on what the EV crisis means for the silver market and for you as a silver investor. This is a pivotal moment. The crisis that has arrived is the crisis we predicted. The shortage that was invisible is now visible. The consequences that were theoretical are now real. The validation could not be more complete. Silver at $118 with EV factories halting production is the beginning, not the end. The crisis will deepen as more industries face the same constraints. The price will rise as the competition for limited supply intensifies. The manipulation will fail as the paper market loses credibility. The repricing will be dramatic as the true value of silver is recognized. For those who own physical silver, the message is simple. Hold. The gains you have already made are substantial, but the gains to come may be even larger. The EV crisis is the catalyst that will attract a new wave of buyers. The mainstream attention that has eluded silver for years is now arriving. The narrative is shifting. The price will follow. For those who are considering silver, the message is equally simple. Buy. The crisis that is unfolding validates the thesis in the most powerful way possible. The physical shortage is real. The price is rising because it must. The opportunity is now, not later. Later, the price will be higher. Later, the availability will be worse. Later, you will wish you had acted when you had the chance. The EV industry broke today because of $118 silver. But the breaking is just beginning. The solar industry will break next. Then electronics, then medical devices. Each industry that depends on silver will face its own moment of reckoning. Each reckoning will drive the price higher. Each price increase will accelerate the reckoning in the next industry. This is the new reality. Silver is no longer a cheap industrial input that can be taken for granted. Silver is a strategic resource, a monetary metal, and an investment asset. The price will reflect all of these roles. The price will rise until supply and demand are balanced. That balance point is far above $118. This has been Silver Storm Daily. The EV industry is broken. Tesla, Volkswagen, and BYD have halted production because of $118 silver. The crisis validates everything we have been saying about the shortage. The crisis is just beginning. The price is going higher. Hold your mettle. Buy more if you can. Stay informed. Stay connected. The storm is here, and we are riding it to a future that few imagined but we always knew was coming. Like, subscribe, and share this video with everyone who needs to understand what happened today. The EV crisis is the silver story breaking into the mainstream. The attention is coming, the money will follow. Be positioned before the crowd arrives. See you in the next report.